One of the biggest concerns people have about reverse mortgages is this: what does it cost? And that's a very fair question because whenever you hear about a loan, you want to know exactly what the fees are, how it works, and whether it's worth it. Today, I'm going to walk you through the real costs of a reverse mortgage in plain English. No hiding anything, no confusing terms, just a simple explanation so you know what to expect. And by the end of this video, you'll understand why some people decide it makes sense and why others decide it doesn't. Yes, reverse mortgages do have costs, just like any other mortgage. But the way the costs work is different from what most people expect. With a traditional loan, you usually pay costs out of pocket. With a reverse mortgage, most of the costs are built into the loan itself. That means many homeowners don't have to write a check at closing. This is one reason people sometimes assume the fees are higher, but that's not always the full story. There are a few main types of costs involved. First is the origination fee. This is the fee paid to the lender for setting up the loan. Second is closing costs. These can include things like the appraisal, title work, and standard mortgage fees, just like with any home loan. Third is mortgage insurance. This is required on federally insured reverse mortgages, and it protects both the homeowner and the lender. These are the three main areas where costs usually come from. Let's look at a simple example. Let's say someone owns a home worth about $400,000. Their closing costs might include the appraisal, title fees, and lender fees, similar to what you would see with a refinance. They may also have mortgage insurance added to the loan, but instead of paying all of that out of pocket, these costs are usually included in the balance of the reverse mortgage itself. So the homeowner isn't writing a big check. The costs are simply part of the loan. This is one of the reasons people choose this type of loan later in life. A lot of people ask about the mortgage insurance. They wonder why it's there. The reason is because reverse mortgages are designed to protect the homeowner. This insurance makes sure that even if the loan balance grows over time, you can never owe more than the home is worth. It also guarantees that you can stay in your home as long as you follow the program rules. So the insurance isn't just a fee, it's part of what makes the program safe. For some homeowners, the costs make sense. For example, if someone has a large mortgage payment and wants to eliminate it, the reverse mortgage may free up monthly cash flow. If someone needs repairs on the home, the funds may make the home safer and more comfortable. If someone wants a line of credit for the future, the reverse mortgage can provide that flexibility. In those situations, the benefits may outweigh the costs. But there are also times when a reverse mortgage may not make sense. If someone plans to move soon, if they only need a very small amount of money, or if they want to leave the home completely untouched for heirs, then the costs may not be worth it. And that's why it's important to look at each situation individually. A reverse mortgage isn't right for everyone, but when you understand the costs clearly, it becomes much easier to decide whether it's worth looking into. If you'd like to see what the numbers look like for your situation, you can request a free home equity checkup using the link below. There's no obligation, it just gives you the facts. And if this helped you understand reverse mortgages a little bit better, subscribe to the channel. We'll keep explaining these topics one step at a time so you never feel confused or pressured.